Welcome to this breakdown. Today, we're diving straight into the latest data and fresh IRS rules to build your actionable 2026 retirement playbook. We've all seen the dramatic headlines about the changing landscape of retirement, right? But instead of stressing, we're going to cut right through the noise. We'll be pulling from some incredible new data from Northwestern Mutual, the IRS, and top market researchers to lay out a clear, actionable roadmap to secure your financial future. So let's just go ahead and address the elephant in the room right off the bat. Americans now believe they need a staggering $1.46 million to retire comfortably. Yeah, that's a massive 15% jump from just a few years ago, straight out of the 2026 Planning in Progress study. It's a pretty stark reflection of persistent inflation, a shifting economy, and, frankly, the realization that retirement just isn't what it used to be. And because we're all living longer, the most pressing question on everyone's mind isn't just about hitting that massive number. It's about ensuring your money lasts exactly as long as you do. The data shows the average U.S. adult still plans to retire at 65, but thanks to modern medicine, that retirement could easily stretch 30 or even 40 years. People are waking up to the fact that their money has to work a heck of a lot longer than we used to think. To tackle this, we're going to walk through a 5-step playbook. The new magic number, 2026 contribution limits explained, maximizing the employer match, picking low-cost index friends, and finally, history says stay the course. Starting off with step 1, the new magic number, decoding the $1.46 million goal. We really need to unpack where this massive expectation is coming from. And what's super interesting here is the generational gap. Just think about how Gen Z is responding to this. They're actually starting to save at age 22. That's a full decade earlier than the average Gen X worker, who started at 32. Plus, nearly a third of Gen Z fully expects to live to 100. Meanwhile, a pretty shocking 26% of Gen X hasn't even started saving yet. It really highlights how younger workers are aggressively adapting their timelines to account for living significantly longer. Which brings us to a major point of anxiety. Nearly half, 48% of all Americans, feel it's highly likely they'll actually outlive their savings. Honestly, this is the core fear driving that $1.46 million target. When you map out the potential costs of healthcare, long-term care, and just everyday living over a 3-decade span, the math can feel, well, incredibly daunting. But let's make that $1.46 million a bit less intimidating. Rules of thumb, like the classic 4% rule, show that this giant nest egg translates to a much more digestible $58,000 in annual retirement income. You essentially withdraw 4% of your savings in year 1 and then just adjust for inflation after that. Or think about the $1,000 a month rule, which tells us that every $1,000 of monthly spending requires about $300,000 saved. Seeing it broken down into an annual salary really helps map that huge goal back to your actual day-to-day lifestyle. Moving on to step 2, 2026 contribution limits explained. You gotta know the rules. Building that nest egg brings us straight to the brand new IRS limits for 2026. The government updates these regularly for inflation, and mastering them is literally your primary lever for wealth building. So the base 401k and 403b limit just bumped up to $24,500 this year. That gives you a higher ceiling to stash away pre-tax money. But the catch-up opportunities are where it gets really powerful. If you're 50 or older, you get an extra $8,000 allowance. And even better, there's a brand new super catch-up of $11,250 specifically for folks aged 60 to 63. That allows for a massive late career savings sprint. Now, if you're a high earner, pay close attention to this new Secure 2.0 rule. If your FICA wages exceeded $150,000 last year, your catch-up contributions are now strictly forced into after-tax Roth accounts. This is huge. It means you will no longer get a current year tax deduction for those extra catch-up dollars. For most payrolls, this shift happens automatically, but it is a massive change for your tax planning strategy. The difference between these two accounts is pretty striking. With a standard pre-tax 401k, your contributions reduce your taxable income today, but you get taxed when you withdraw in retirement. With the Roth 401k, you pay the taxes up front. So while higher earners lose that immediate tax break on those catch-up dollars, they're actually gaining completely tax-free growth and completely tax-free withdrawals for the future. Not a bad trade-off. Okay, step 3, maximizing the employer match. Seriously, do not leave free money on the table. This right here is where your company literally helps you build that $1.46 million. It's one of the absolute fastest ways to grow your balance. The average employer match in 2026 sits right between 4 and 6% of your salary. It acts as an automatic bonus if you just participate. Think about that. If you make $100,000 a year, a 6% match is an extra $6,000 flowing into your retirement account annually with zero extra effort from you. Skipping this is literally leaving a massive part of your compensation behind. You absolutely have to read the fine print of your benefits package because the structure completely dictates your strategy. A partial match, like say a 50% match up to 6% of your salary, requires you to contribute a higher percentage of your own money to unlock their maximum dollars. In that specific scenario, you've got to put in 6% just to get their 3%. This is totally different from a full dollar-for-dollar match, where your 3% automatically earns their 3%. You've got to know your company's exact formula. On to step 4, picking low-cost index funds. These are your vehicles for growth. So your money is flowing in, you've secured the match, now you need the engine. We have to look at exactly where to park this cash to maximize returns. Research consistently shows that actively managed funds underperform the S&P 500 roughly 90% of the time over a decade. Because of that, your primary focus should really be on simple, broad index funds. You want to pay laser-sharp attention to the expense ratios and minimum investments. Great funds like Fidelity's FXAIX or Schwab's SWPX offer incredible value. We're talking fees as ridiculously low as 0.015% and absolutely zero minimum balances to get started. Now, the difference between a 0.015% fee and a 0.20% fee might sound microscopic, right? But let me tell you, over 3 decades, those tiny fractions compound into massive portfolio-draining losses. Every single dollar you pay in fees is a dollar that isn't compounding for you year after year. Keeping your investment costs relentlessly low is one of the very few things in the market you have total control over. And finally, step 5, history says stay the course. It's all about the mindset. You can have the perfect tax strategy, you can have the lowest fees in the world, but if you don't have the right mindset to protect your wealth, none of it matters. The market is going to test your nerves. Looking at the historical data of the S&P 500 since 1970 is absolutely wild. It proves that despite wars, global pandemics, inflation spikes, and severe financial crises, a $10,000 investment still grew exponentially. The market climbs what analysts call a wall of worry. The news is usually bad. World events are often scary, but the market consistently rewards long-term patience over short-term panic. This historical resilience really needs to reframe how we view volatility. Even though the market drops an average of 14% at some point during almost every single year, it usually finishes the calendar year with positive returns. Those intra-year dips, they aren't anomalies. They are a completely normal, expected part of the process of building wealth. Sitting in cash during a downturn might feel safe, but it actually creates a dangerous mathematical trap. To make it work, you have to perfectly time both your exit and your re-entry. If you sit on the sidelines waiting for the dust to settle, you risk missing out on massive, rapid rebounds. And if you miss those rebounds, you permanently lose out on the future compounding growth of that money. The cost of trying to outsmart and time the market is incredibly steep. Knowing the contribution limits, maximizing your employer match, and minimizing those pesky fund fees, all of that gets you onto the playing field. But staying the course through inevitable volatility, that's what actually builds that $1.46 million. The U.S. market has proven decade after decade that it is ready for the long haul. So the real question I'll leave you with today is your 2026 plan, and more importantly, your mindset, ready to match it? Thanks so much for diving into this breakdown with me, and happy planning.